Let's learn about money market instruments.
Hi, Assalamualaikum and good evening to everyone. My name is Erra Najihah binti Shahrol Kamal and my matric number 255856. So today I will explain about repurchase agreement, which is repo. A repurchase agreement repo is a short-term agreement to sell security in order to buy them back at slightly higher price. Repos are secured by collateral such as security. A haircut is applied to mitigate against the counterparty risk and to mitigate against a decline in the value of the collateral. One party sells security to another and decide to buy the security back at the future date. The buying back part of the agreement is known as repurchase agreement. The borrower is said to have entered into a repo agreement. The difference between the original price of the security and their repurchase price is the interest charge known as the repo rate. Repo rate works based on this picture is Bank A is taking a loan of 100 crores rupees from RBI for 1 day and putting government bond of the same value as security with a promise that they will buy this government security back after 1 day. After 1 day, Bank A returned 100 crores rupee plus interest amount to RBI and get back his security. So, this is a repo transaction from side of Bank A. The security transacted here can be either government security or corporate security or any other security which the RBI permit for transaction. The duration between the two transactions was 1 day in our example is called as the repo period. Predominantly, repos are undertaken on overnight basis. The purpose of repo market created to allow financial institutions that own a lot of security, such as bank, broker-dealer, hedge funds, to borrow cheaply and allow party with a lot spare cash to earn a small return on that cash without much risk. Repo function as collateralized debt, which reduce the total risk. And because the repo price exceeds the value of collateral, this agreement remains mutually beneficial to buyer and seller. In this repurchase agreement, usually involve two parties, which is the seller and buyer. For the party selling the security and agreeing to repurchase it in the future is known as repo. For the party on the other end of the transaction, buying the security and agree to sell in the future is known as reverse repurchase agreement. As we all know, buyer acts as a short-term lender when the seller acts as short-term borrower. Therefore, each party has their own right, such as seller have right buy back the security in the future, while buyer have right to sell those security to a third party to offset his loss if the seller default during the life of the repo. Each party have their own obligation. The seller need to repurchase the security sold at the maturity date. If the seller may fail to do that, the repo seller default on their obligation, while the buyer needs to secure those security. But if the seller default during the life of the repo, the buyer have right to sell those security to a third party. Of course, every agreement has their own risk that we need to avoid from happen. The largest risk in the repo is the seller may fail to hold up its ends of the agreement by not repurchasing the security which is sold at the maturity date. In this situation, the buyer of the security may then liquidate the security in order to attempt to recover the cash that it paid out initially. As with any loan, the creditor bears the risk that debtor will be unable to repay the principal. Repos function as the collateralized debt, which reduces the total risk, and because of the repo price as the value of collateral, this agreement remains mutually beneficial to the buyer and seller. Repo pricing is a typical of conventional debt instrument in that haircut also needs to be determined. In fact, repo transaction negotiation cover simultaneously both the haircut and the repo rate. After initial terms are set, such as the principal amount of unit of the security and maturity, a trader at a dealer bank need to respond with haircut and a repo rate when he approached by investor for their financing request. Trader and investor alike will need pricing model to proceed, especially considering the wide spectrum of different asset classes and repo terms and the lack of broadly available existing market pricing mechanism. Any secondary market repo classified as a money market instrument. A repurchase agreement function in effect as a short-term, collateral-backed, interest-bearing loan. Repo also a part of secondary sector and repos in over-the-counter market. You can have access this instrument by selling, pricing, and distribution of the commodity will take place between the negotiating parties. How does the instrument used in a bank treasury operation? Okay, in a repo transaction, the desk repurchased treasury, agency debt or agency mortgage-backed security (MBS) from a counterparty subject to an agreement to resell the security at a later date. It is economically similar to a loan collateralized by security having a value higher than loan to protect the desk against market and credit risk. Repo transaction temporarily increase the quantity of reserve balance in the banking system. They are also a common tool of central bank open market operation. Last but not least, any official guideline regulating those instruments and who are regulating agency. Yes, it had. The purpose of the guidance notes on repurchase agreement transaction is to provide a set of best practices on repurchase agreement transaction as well as specific regulatory requirements that should be observed by licensed financial institutions when undertaking repo transaction. The guidance notes are issued pursuant to Section 126 of Banking and Financial Institutions Act (BAFIA) 1989 to be complied with by the licensed financial institution in their conduct of repurchase agreement repo and reverse repo transaction. Any other rule, guideline, circular or directive as may be issued by Bank Negara Malaysia (BNM) from time to time. That's all from me. I will pass to my friend to continue. Thank you.
Hello guys, my name is Teh Yee Shi and I will share you the information about the certificate of deposit as known as CD. I will show you how it works and some information you need to know before you want to invest in CD. So let's learn about it. CD is a money market instrument. It is also a type of saving account usually issued by commercial banks, which restricts you access to the money you invest but offer much higher interest rate than those associated with regular saving accounts. The deposit gains value over an agreed upon duration. You may feel a little bit confused with the definition, so it's easier to explain you like this. First, you buy or invest in CD with an amount of money, and then there will be an interest rate being paid to you, and it will grow annually. So the CD will earn money in terms of the interest in a period of time, but the money must remain in the account for a period too. Finally, you can withdraw the money after the period is over and you will receive your principal amount plus interest, but it could be subject to fees if withdrawn before the end of the time. So you have to keep in mind. But how we calculate the CD? Well, here is an example for you, or you can just search through the internet CD calculator, and the internet will help you to calculate your CD. Because you know nowadays internet offers you a lot of convenience, so you don't need to remember the formula. Well, there are two parties involved in the CD: an account owner, the investor who purchased the CD, and a bank or credit union, which the lending institution that issuing the CD. So usually most of us can invest in CD, you and me, and the company, trust funds, banks, and associations. The maturity period of CD is usually minimum 7 days and maximum up to 5 years. Next, should we invest in CD? Well, there are pros and cons. Pros are CD is low risk and safety guaranteed by government, and it has higher interest rate than other deposit account and easy to buy. But the con is lower rate of return than investment account, and there is a penalty if you withdraw the money earlier than the maturity date. So keep in mind. From the point of view of issuing bank, it is critical to raise the resource in time of need and improve their lending capacity. Then the CD are fixed term deposit which cannot be drawn until the redemption date. So it is an ideal instrument for the bank with a short-term supply fund to invest and attractive. However, the CD market is surprisingly complex. You can buy a variety of CD on both primary and secondary investment markets. Within the CD arena, you can just buy the CD from the primary market, which you just take the loan from your local bank or credit union and you bought a CD. And the secondary market involves investment broker acting as an intermediaries. So the brokers buy the CD from the banks or from other investors who currently hold the CDs and sell it to you. While in US, the deposits are protected by the FDIC, Federal Deposit Insurance Corporation, unlike in the other countries. So the FDIC protects US people money in the event of the bank failure. So the FDIC insurance applies to the first $250,000 you have in your deposit account at the given bank. But FDIC won't insure money beyond this limit in your total account with one bank. So if you have a saving account and two CDs at a given bank with $300,000 across the three accounts, then in the event of a bank failure, you would be only guaranteed to get back the $250,000 of that $300,000. That's all from me. I hope you learned something from this and have some knowledge if you want to invest in CD. See you again. Bye.
Good afternoon, sir. My name is Teng Xin Yi, matrix number 252862. Now I am going to continue with the next part of the money market instruments, which is banker's acceptance. A banker's acceptance is a short-term issuance by a bank that guarantees payment at a later time. A banker's acceptance is often used in importing and exporting, with the importer's bank guaranteeing payment to the exporter. So what are the purpose of banker's acceptance? Banker's acceptance are used by companies as a relatively safe form of payment for large transactions. Banker's acceptance are most frequently used in international trade to finalize transactions with relatively little risk to either party. How is a banker's acceptance being created? First, an importer can use a banker's acceptance to finance his purchase of goods from foreign suppliers. Next, after negotiating prices with the foreign exporter, the importer creates a time draft and presents it to his bank. The bank accepts the draft, discounts it, and gives the importer cash, which he uses to pay his foreign suppliers. Last, on or before the maturity date of the accepted draft, the importer must pay the bank the face amount of the acceptance. In short, the parties that involved in the banker's acceptance transactions are the issuer of banker's acceptance, which is the importer, the receiver of banker's acceptance, which is the exporter, the depositor banks, and the remittance bank. So, are the banker's acceptance safe to use in transaction? The answer is yes. Bankers' acceptance are considered to be relative safe investment because the bank and the borrower are liable for the amount that is due when the instruments matures. So you may wonder, how is a banker's acceptance discounted? The banker's acceptance trade as a bearer instruments at a discount from face value. For example, if an accepted draft has a face value of $100,000, the holder would be able to sell the draft for a lesser amount. Let's say it's $97,500 in the secondary market. The discount amount fluctuates with current interest rates. The interest rate for bankers' acceptance is usually at a small spread over the current rates for US Treasury bills. Next, can bankers' acceptance traded in the money market? The answer is yes. Bankers' acceptance can be traded at discounted face value in the money market. Last but not least, I will share with you on the pros and cons of bankers' acceptance. The pros of the bankers' acceptance are: it reduces financial risk of the exporter, increased opportunities of international trade, only small fees needed to process the banker's acceptance, credibility, and less documents needed. On the other hand, the cons of banker's acceptance are strict assessment on the issuer, financial aspect, and the need of collateral. That's all from me. Thank you.
Good day everyone, my name is Wong Weng Kei, metric number is 252886. Today I'm going to present the money market instrument. One of the money market instrument is Treasury Bill. I will focus on United States Treasury Bill. Let us know what Treasury Bill are. Okay, what is a Treasury Bill? A Treasury Bill is a short-term US government debt obligated backed by the Treasury Department with a maturity of 1 year or less. Treasury bills are usually sold in denomination of $1,000. However, some can reach a maximum denomination of $5 million in a non-competitive bid. These securities are widely regarded as low risk and secured investment. Besides that, U.S. Treasury securities are issued by the federal government and are considered to be among the safest investments you can make because all Treasury securities are backed by the full faith and credit of the U.S. government. This means that come what may recession, inflation, war, the U.S. government is going to take care of its bondholder. On top of that, what is the purpose of creating T-bill? The U.S. government issues T-bill fund various public projects such as the construction of schools and highways. When an investor purchases a T-bill, the U.S. government is effectively writing an IOS up to the investor. T-bills are considered a safe and conservative investment since the U.S. government backed them. On top of that, how can we earn from T-bill? First, T-bill issued at a discount from the par value. The purchase price is less than the face value of the bills. For example, a $1,000 bill might cost the investor $950 to buy the product. When the bill matches, the investor is paid the face value, which is par value of the bill they bought. If face value amount is greater than the purchase price, the difference is the interest earned from the investor. Other than that, where can we purchase the T-bill? The first platform is non-competitive bids. Payment is made through the Treasury Direct or the investor, bank or broker. The second platform is competitive bidding auction. Purchase payment must be made either through a bank or a broker. The third platform is secondary market. Investor can buy or sell Treasury bill on the secondary market. Also, there are mutual fund and ETF that hold previously issued T-bill. Besides that, what are the pros and cons of T-bill? First, the advantage of T-bill is zero default risk since T-bill has a U.S. government guarantee. Second, T-bill offers a lower minimum investment required of $100. Furthermore, interest income is exempt from state and local income tax but subjected to federal income tax. Lastly, investor can buy and sell T-bill which is in the secondary bond market, which means that it's liquidity. For the disadvantage of T-bill, is T-bill offer low return compared with other debt instruments when compared to certificate of deposit. Second is the T-bill pay no coupon interest payment leading up to its maturity. Third, T-bill can inhibit cash flow for investors who require steady income. Lastly, T-bill have interest rate risk, so their rate could become less attractive in a rising rate environment. Other than that, what factors that affect T-bill price, which means the risk of T-bills? First is the monetary policy. T-bill interest rate move closer to the interest rate set by the federal fund rate. A raise in federal fund rate tend to attract investment in other debt security, resulting in a drop in T-bill interest rate. Second is maturity period. The longer the maturity period of T-bill, the higher rate of required by investor. Besides, there is risk tolerance when the U.S. economy is going through an expansion and other debt securities are offering a higher return. T-bills are less attractive, will therefore be priced lower. After that, inflation. If the inflation rate higher than the rate of return of T-bill, then the T-bill will less demand and the price will fall. That's all is my presentation. Thank you.
Assalamu alaikum wa rahmatullahi wa barakatuh. My name is Mohamed Hassen Nur. My matric number 260485. Today I'm going to talk about money market funds. Money market fund is an open-ended fixed income mutual funds that invest in short-term debt securities such as Treasury Bills, municipal bills, and short-term corporate and bank debt instruments that come with a low credit risk and emphasizes liquidity. The purpose of money market fund is to provide investors a safe avenue for investing in a secure and highly liquid cash equivalent debt assets using smaller invest amounts. In the realm of mutual fund like investments, money market funds are characterized as low risk and low return investment. Many investors prefer to park substantial amounts of cash in such fund for the short term. However, money market funds are not suitable for long-term investment goals and like retirement planning. This because they don't offer much capital appreciation. Who and how money market was created? Money market funds were designed and launched during the early 1970s in the US. They gained rapidly popular because they were an easy way for investors to purchase a pool of securities that in general offer a better returns than those available from a standard interest-bearing bank account. What are the types of money market fund may invest? There are five types of money market funds may invest. First, bank risk acceptance, which is short-term debt guaranteed by a commercial bank. Second, certificate of deposit, which is bank issued savings certificate with a short-term maturity. Third, commercial paper and secured short-term corporate debt. Fourth, repurchase agreement, short-term government securities. The fifth, US Treasury short-term government debt issues. Types of money market funds. The Securities and Exchange Commission regulation comprise three categories of money market funds based on the securities in the fund. First, government. The funds invest in about 99.5% in government-backed securities such as US Treasury Bills, collateralized US Treasury securities, repurchase agreements, and federal loan securities. They also invest government-sponsored enterprises securities. Since government-backed paper is risk-free, the funds are considered very safe. Second, prime. They are funds invested in short-term corporate debt instruments such as commercial paper, corporate notes, and short-term bank securities, such as bank acceptance and certificate of deposit. They also include repurchase and reverse repurchase agreements. Third, municipal tax-free. The money market funds are predominantly invested in securities issued by municipalities, which are federal and overall state income tax exempt securities. Pros and cons of money market funds. Pros: very low risk, highly liquid, better returns than banks' accounts, no minimum requirements. Cons: Federal Deposit Insurance Corporation is not insured, no capital appreciation, sensitive to interest rate fluctuations, monetary policy, and low returns. Money market funds are usually very safe. They allow easy access to the cash invested, and they don't require minimum. The worst disadvantage is that money market funds are not insured by the Federal Deposit Insurance Corporation. When interest rates are low, these funds may pay less than the rate of fluctuations. When that happens, fund investors are actually losing their purchasing power. Benefits of using money market funds. First, risk management. Money market funds act as a risk management tool, as funds are invested in a cash equivalent securities with a low risk and high liquidity. Second, short term. The short-term nature of money market funds ensures a low interest rate, credit and liquidity risk. Third, security. Money market funds invest in a low risk and high credit quality securities, ensuring a high security. Fourth, stability. Money market funds are a low volatility investments. Fifth, diversification. Money market funds usually hold a diversified portfolio of government, corporate and tax-free debt securities. Money market fund risks. First, a credit risk. Money market securities are susceptible to volatility and are not Federal Deposit Insurance Corporation insured. Hence, the potential to not lose money, however low, is not guaranteed. Second, low returns. The low returns of money market funds are usually lower than the other funds comprising of assets such as stock and properties. There is a chance that money market returns may also fall below the fluctuation rate, providing negative real returns to investors. Interest rate can also go down further, reducing returns on money market investments. Third, environmental changes. Changes in economic policies and government regulations can result in an adverse impact on the price of money market securities and their issuers' financial standing. For example, if they affect interest rate and money supply.